And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets. 9 minutes after 6. Good evening. Welcome to the program. I'm Stephen Grootes. What makes you change what you order at a restaurant or go to order something at a restaurant? And I ask this because in the Spur results that are out today, they seem to have sold a lot more pizza through Panarottis, but they're trying to sell more pasta. And then this sort of carb-conscious age, I think trying to sell more pasta at dinner time might be a tough ask. What would make you sort of move from what you normally have to something different? Have you done it recently? And the restaurant experience? I mean, whenever I ask about the restaurant experience, whether I'm asking friends, whether I'm at a braai or something, the same feedback comes. It's just so expensive. And I think that's still, the case. And Spur does talk about that. The Spur Group talks about that in their results. They still did pretty well, and we'll speak to their CEO in a few minutes. But what would make you sort of change the kind of restaurant that you go to? Is there one person in your family? I remember it was such an insight about 20 years ago, 15 years ago maybe, when fish restaurants realized they needed something that wasn't fish on their menu. Meat restaurants they realized they needed something that was vegetarian on their menu because of the one member of the family that didn't eat what everybody else ate, or just, what would always want something else. And so you just had that one dish for them, and that would mean you'd get the whole family coming, whereas that one person would have had a veto. What is it about the restaurant experience nowadays that sort of makes you go, or makes you actually stay at home? And I do wonder about the seasonality. It's been quite cold recently in Joburg. Today, as the temperature sort of warms up, I kind of get that, let's go out. Maybe we should go and do this and do that. Things I didn't think of just 2 weeks ago. Anyway, your views, please. 072-702-1702. Val Nichas is the CEO at Spur Corporation. She'll be on your radio in about 10 minutes. Before that, Ben Magara at Exxaro Resources. Quite a strong period in a way, although for various technical reasons, the results don't quite reflect it in that way. But running, a coal behemoth, I think that would be the right word, in these times during a transition, I think quite a difficult thing to do. So we'll speak to Ben Magara in a couple of moments. The president, and I was struck by how dogmatic the president was today. You're speaking at the launch of phase 3 of the government business partnership. And he said very clearly that reforms are becoming embedded. They won't be reversed. And we'll hear from Martin Kingston on that. He's the chair of the B4SA Steering Committee. But that is one of the questions I get asked that. Can the reforms be reversed? Will they keep going? Well, my sense for the moment is that, yes, they will. I agree with the president, by the way. I don't think they can be reversed. I think they become embedded. And it's very hard to reverse things like increasing the role of the private sector in the railways or wherever. So I think that will happen. And then you want to see change in the country. Well, you can see it in the amount of renewable energy that's being produced through solar and wind right now. Talking of which, we'll speak to Jose Malesha, the energy and finance expert, just before 7 o'clock. Lots going on with the process of curtailment when power producers are asked not to produce electricity for various reasons. We'll talk about that too. Good to hear from you this evening. 011 8830 702 021 446 0567. Pastor, for you? 072-702-1702. Let me know, please. 12 minutes after 6.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, the coal and renewable energy company Exxaro reporting its revenue up by over 7% to 22.1 billion rand in the 6 months to the end of June. Its headline earnings were down, though, by nearly 20%, mainly because of a drop in revenue from its investments in Sishen and Black Mountain. Ben Magara is the CEO at Exxaro. Ben, good evening, and thanks for your time. Your coal production was up, I think, 11%. You had stronger output at Grootes. You said you had an exceptional ramp-up at Matla. How were you able to get to clearly quite pleasing volumes so quickly?
Stephen, good having you this evening. We ran the project very well, and we put 5.2 billion rands into that Matla project. And the mine has come in on time, to budget, and to scope. So Mangaliso, our general manager, Mangaliso Seteti there, and his team have done exceptionally well, both in the early ramp-up of the project, but driving the efficiencies that we expect and doing so safely. Matla operated this past half with no lost time injuries at all. So really, when safety is good, production tends to come through, and the ramp-up has been exceptional. So we're very pleased with the 40% improvement at Matla. We're also pleased, obviously, you have already highlighted the 11% improvement in the total coal production for the whole business from Grootes to Belfast, Leeuwpan, Matla, and Mafube. And the export sales were also very good. So a very pleasing set of half-year results from coal.
Do you think there's any scope to increase that production further? I mean, would this be a good time to do it if you look at prices?
Exxaro has got an exceptional opportunity to expand in terms of export optionality, especially from our Grootes mine in Lephalale. We have 9 billion tons in resources there, and the key lever is our exports and our engagement with Transnet. We continue to see Transnet improving at 5%. So the key value lever for us is to grow our exports, especially from Grootes mine. We have exported from Exxaro about 12 million tons, even though we are currently guiding on 8 million tons, because we can increase. At higher prices, even road transport also becomes viable. But at the current diesel prices, road transport is not as viable. So key is we really see a lot of scope. The world, even though demand globally is reducing, the supply side from the mines is reducing even faster, and Exxaro has the optionality to fill that gap.
You talk about Transnet's improvement. You talk about it in your results today. You do still keep other logistical channels open, though, clearly. I mean, I don't think you're expecting Transnet to go backwards, but sometimes you'll need those other options.
Absolutely. And what we have been able to do, Stephen, is that our direct railing from Lephalale to Richards Bay Coal Terminal is the cheapest route to market. However, we have what we call the intermodal logistics channels, where we are able to move coal from Lephalale to Mpumalanga area and then load it onto the siding. So we run it by road, then we move it onto rail when we get to Mpumalanga. We improved the railing between Transnet and Exxaro. We improved the railing from Grootes direct to Richards Bay by 50% in the last half, and reduced the road traffic by almost 20%. So we think, and obviously it trickles down straight to the bottom line because of profitability, and will continue to do so. So we think there are great opportunities, and the optionalities are big for Exxaro.
Your renewable business is also doing quite nicely. You generated 12% more energy, I presume adding more renewable capacity. How important is that becoming for your business, and I suppose over the longer term?
Indeed, Stephen. Our renewable energy business, we had two plants that have been running for years in the Eastern Cape, Tsitsikamma Wind Farm and Amakhala Wind Farm. In the last year, in December, we commissioned our Lephalale solar plant, which is a 68 megawatts plant, and it's feeding into our own mine, Grootes mine in Lephalale. That's reducing our need from Eskom by 30%. It's also reducing our carbon emissions in terms of Scope 2 emissions by 22%, and providing even a saving in electricity costs of 100 million rand a year. So we are very pleased with the progress we are making on renewable energy, because we believe in the future, just energy transition process, we can be market leaders in coal for meeting the demand required, but because we need coal for the base load. But we are very clear that renewable energy is important for us as we aim to reduce the carbon intensity of our earnings. And so our strategy and target is to have 1,600 megawatts out of wind and solar by 2030.
Your manganese business, sort of 4 months in now, making a positive contribution. Has it been incorporated into your group relatively easily?
We happen to have the same capability and competencies of bulk mining, which manganese does. So, and the joint venture structure we have in there is that we don't quite incorporate it into our company. We are 50% shareholders, 50-50 with Jupiter, which indirectly we also own 20% of Jupiter in Australia. So in a way, we own 60% of CP Borwa. The integration of the business has been fantastic. The safety improvements are great. Production is up 11%. So indeed, it's great to now have it contributing both from our earnings and equity accounting, because we now own 100% of the marketing side of that business, and it's an office we have in Singapore. So we're very pleased with the way manganese has gone. We believe that there's still a great future for us, and we have a project. One of the acquisitions is the Mokala project, which is a mine owned 50-50 between ourselves and Glencore. We are in the process of finalizing that transaction, and we think it should add more to our manganese portfolio.
Ben Magara, thank you so much. Really appreciate the time. The CEO at Exaro, 20 minutes after 6.
7:02. Stephen is on The Money Show.
6 to 8 p.m.
Well, the Spur restaurant group's saying they're selling more pizza at Panarotti's, more burgers at Rockamama's. As a result, their revenue up 8.5%, pushing their adjusted headline earnings up by nearly 9%. But the group having to take a provision because of a dispute in which it may have to pay out nearly 130 million rand. As a result, its headline earnings affected by that. So they're per share down by 38%. Val Nichas is the Spur Corporation CEO. Val, good evening, and thank you very much indeed for your time. Your Spur group, the main group, obviously has momentum. Rockamama's is growing nicely. Panarotti's was able to increase its sales by over 16%. Is pizza becoming more important for you?
Good evening, Stephen. Good to be online. Pizza, I think, is a wanted item in South Africa. We always knew that if we look at the giant QSR players in the pizza category. But we know that at times customers also want to sit at a table and enjoy it outside of a box.
You've been trying to increase your pasta sales. I mean, how do you do that? How do you innovate in the pasta space? And some of us, Phil, are a little conscious about eating carbs.
But I think pasta is such a universal product and spans every family member, if you think of how kids love it. I think the first thing we did was really to re-engineer our pasta sauces to make sure that they were best in class and chose the right pasta and the right sauce combinations. But I think what generated the additional interest in pasta was that our marketing teams with our brand teams deliberately promoted a combo offer in a way that was the two delish, so you can either choose a pasta or choose a pizza. So I think, again, it's all about creating awareness of a category that helps to try and entice customers to try new things.
Your John Dory's brand, sort of seafood chain, it's really battling. Sales down 11%. It hasn't had momentum in a while. What's going wrong there, Val?
Yes, I think John Dory's will still be seen to be struggling for a bit till we rationalise the process and look at which stores will survive. There are still many stores that do well, and also a lot of franchisees that are very committed to the brand. I think the seafood category is a challenging one currently. We can see it amongst other competitors, and I think it is a more sensitive protein. So when consumers are strapped for cash, I don't think they're going to venture into something that's sort of not niche, but not everyone eats seafood. It also is a more expensive item and perceived to be expensive. So I think it is challenging, but I think it's all about brands. You know, brands have got to have a strong brand differentiator, a value proposition that's unique to them, a distinctive taste. And I think the John Dory's brand has gone through a journey. You know, it started in KZN. It was very successful in KZN. I think it did struggle to make inroads in the Gauteng region, where there's a lot more competition, and perhaps a more major metropolitan area where consumers have got a lot of choices. So, yes, we still believe that there's a future for John Dory's, and we've got some plans in place. We're busy developing something that the market will see in a few months' time. So let's see. I think we must just be patient. It is the smallest brand, but it still made 8 million rand profit this year.
So you're not thinking of shutting it down?
No, not at the moment. We have too many loyal franchisees that love their businesses.
You've been refreshing some of your Spur restaurants. You talk about the one in Pretoria that had long wait times for people because of the refresh you did there. And it's a model of family dining that's been going for a long time. How do you refresh an old brand in a way that gets younger people to come into this very established brand?
Yes, that's such a good question. Yes, and we must remember that all the refurbs and the reinvention obviously is invested by the franchisee. We help develop the concept and the look and feel. And we know that Spur attracts obviously young families and also sort of individual adult diners, etc. But we know that we would want it to be a place where sometimes the young adults come to, and they certainly do come, and some of our restaurants have got teen zones, so you are getting a slightly older child, but we know that what we've got to do in our restaurants is look at creating the opportunity. What is the connection point? So is it about coming to have non-alcoholic cocktails, or is it to come and share a plate of wings and jerky sauce? So we are still getting those youngsters. Like if you look at our restaurants that trade in the university areas, Potchefstroom, Grahamstown, Spur is a very popular place because we've also got specials for students. So I think the wonderful thing about the Spur brand, I think it spans the entire family. We've got a menu that's quite diverse and has lots of options for people to choose, whether you're young, whether you've got limited spend. So I think at the moment we are attracting them. Do we want to attract more young people? Absolutely, because they are future young families.
You've been involved in a long-running dispute with GPS Foods. It involves a supposed oral contract to work together to create a rib processing facility. You've always said you're confident of winning it, but an arbitrator did rule against you, which is why you had to make this provision. Are you still confident you won't have to pay out that money?
Look, we don't know. I mean, the only thing we can do is trust the process, and we're going to go through it, and let's see. It's got to be whatever result it is, we will face it and accept it, but we were also surprised at the outcome, if you consider the facts.
Well, Nichas, thank you very much indeed. The CEO at Spur Corporation. Do appreciate it. 26 minutes after 6.
The Money Show.
The Markets.
Alyssa Viljoen is the Managing Director at Merchant West Investments. Alyssa, good evening. You would have heard that conversation with the Spur CEO there. Apart from the provision, things seem to be heading mostly in the right direction. But the provision obviously weighing heavily on the headline earnings.
Yeah, hi, Stephen. Agreed. So when we look at this result, you actually need to strip it out and say, what is the accounting result and what is the actual trading result? And that headline earning, if you strip out that legal provision, grew by about 9%. So the underlying business is looking healthier. But what I'd really watch for, and in any type of business like this, is the like-for-like sales growth. And that's about 3.6% now for Spur. So your total franchise turnover grew about 7%. But that's basically them just acquiring restaurants. That's adding more restaurants. But like-for-like tells you what's happening underneath the hood, what's happening in the business. And 3.6% does say demand is still there, but people are certainly being more careful. This is a discretionary spend. The Spur is a restaurant. And when we look at the group revenue, it grew about 8.5%, and this is in a really tough environment. We've got rising input costs, foot and mouth disease also increased your beef costs, so you've got strong competition as well. So I would say that the like-for-like sales growth might be a bit soft at 3.6%. But I think, Stephen, what is a good signal from management, and they did actually touch on this quite briefly, was they did raise their dividend by 9%. And I think this is a really good signal to the market, where they're saying this legal issue that we have, that this legal issue that we've raised now, isn't really going to change the economics of the business. I think that's really positive. They're showing that they're cash generative, and I think that's really good for Spur.
Exxaro, in a way, a similar thing. For technical reasons, their results don't look as good, but certainly they sold more coal.
Yeah, agreed. So that coal business did hold up quite well. Production was up about 11%, and exports were up about 15%. So it's not really a collapse of the coal business, but earnings did come below expectations, and we saw that already last week, Friday, from a trading statement that they released. And what was the reason is we saw that acquisition-related costs on that manganese deal was higher than expected, while the equity income from manganese was lower than what the market had hoped. So there's two opposing methods here that at play, and I think that really takes you to this bigger question of Exxaro, of that investors have, is the capital allocation of the business. Exxaro is a very cash generative coal business, but the question is that cash, should it be returned to shareholders, or should you use the cash to build a bigger metals business, particularly like a manganese business? So I think shareholders are questioning this.
And very quickly, I mean, the U.S. Treasury buying back more bonds had a brief impact on the market. What signal does that decision by Scott Bessent send us?
Yeah, agreed. So I think it's quite interesting because 2 weeks earlier at the quarterly refunding meeting, the Treasury had indicated that the buyback sizes would remain unchanged. Now they've actually gone and they've changed this mid-quarter, the buyback from about 2 billion to 4 billion. And in the overall picture, it is small, but, I think when there's a bigger message here that the Treasury is actually concerned enough to act on this. So they are managing their liquidity. This isn't a crisis, but it is a signal to investors that investors might be demanding a larger premium on the long end of bonds because they are looking at inflation risk. They are looking at fiscal deficits and the future borrowing needs that the US has.
Alyssa Fullion, thank you so much. Managing Director at Merchant West Investments.
WhatsApp Stephen
on 072
702
1702.
22 minutes now to 7 the time. What would make you change what you order at a restaurant? I mean, pasta, carb conscious, what? One or two voice notes on that this evening. The Spur group saying that at Panarottis they're trying to get people to buy more pasta on 072 702 1702.
Steve Ovo, I know Panarottis sells pasta, but I think they should blame it on themselves and not that the customers are not buying it. Panarottis is promoting pizza more than they promote their pasta. And most people who would go to Panarottis will go for pizza mostly because that's what they advertise most. Even their slogan saying Panarottis big on Panarottis big on family, big on pizza. And I think they've concentrated more on pizza as compared to pasta. And I also don't know what are the pasta offerings at Panarottis, because basically I can tell you the pizza flavors at Panarottis, but I can't tell you the pasta offerings just because they're always concentrating on advertising pizza.
No, sure. I hear you. And it can be difficult also if you've got a brand that's been doing one thing for a long time and you're trying to expand other parts of it. On the other hand, if you want everyone in the family to be happy, you are going to have to do something that's pasta as well, I suspect. Tolakela, do you do, carbs at dinner? I did that when I was younger. No, not so much.
Life's too short to pass carbs, Stephen. It's funny when I'm listening to this voice note. I don't go to Panarottis for the pizza. I prefer the pasta because they've got like a chorizo pasta that I'm obsessed with. But I think the reason that the pizza gets pushed more than anything, because it is a family restaurant and kids love a pizza.
They do.
So I think when they're thinking that, they're like, what's the quickest thing that the kids can enjoy and can kind of go in and out of? Because with pasta, a lot of the times you need to eat it while it's still like warm. Otherwise, you don't enjoy it. So unfortunately for themselves, because they also have the play area, it's easier for the kids to keep on going and coming back for the pizza than it is for the pasta.
That's true. And I've never tried to warm up pasta in an air fryer, but I don't think it really works in quite the same way. 22 minutes now to 7.
702.
702.
Stephen is on X.
At Stephen Grootes.
7:15 the time. The President speaking today at the launch of Phase 3 of the Government Business Partnership. He was in Hyde Park. One of the points he was making was about how important it was to embed the reform that's already happened and that it won't be reversed.
In Phase 3, we must deepen implementation, embed the reforms more clearly, and we must also make progress that cannot be reversed. People have been concerned that are these reforms reversible? Will they be reversed one day when something happens? My answer is that no, they are not going to be reversed. We want to embed them so that they do not reverse. This phase must be defined by disciplined execution. You know what I mean when I say when something happens. So we want to ensure that the reforms are not going to be reversed. And every work stream must have the clear objectives that our structures, our JSOC must also work on. We must have measurable targets and firm timelines and accountable leaders. Where there are problems, we need to talk about them.
Well, one of the people at the event today was Martin Kingston, the chair of the Steering Committee of B4SA. Martin, good evening and thanks for your time. I mean, it's the key question about the reform process. Do you agree with the President that the reform we've seen so far won't be reversed?
Oh, I'm absolutely in agreement, Stephen. There's no doubt in my mind, I think, nor in the mind of business, that the amount of work that's taking place, the traction that has been established, does mean that it's reversible, and not just in the areas that we are familiar with, such as transportation and energy, but in many other areas as well. And this launch of Phase 3 is just another manifestation of that process, both structural reform and ensuring that the private sector can play an appropriate role, both using its skills and expertise, but mobilizing capital and operational experience wherever that's possible.
We've had two phases of this partnership, but with government and business already. What's going to be the focus then of the third phase?
Well, the first two phases, as you know, was establishing the partnership in the context of the economic crisis, dealing with energy, transport and logistics, crime and corruption, putting it on the platform, and addressing youth unemployment, which of course is a massive crisis currently confronting the country. Although we've still got pedestrian growth of 1.5%, the Treasury is forecasting 1.6%. We need to be at above 3% on a sustained basis to stop unemployment levels increasing. We've got 8.5 million people out of work in the country at the moment, and roughly 300,000 new net work seekers entering the labour force every year. So how do we get above 3%? And we've identified 4 sectors which we think are both very significant natural resources in the country and able to contribute more to both growth and employment creation, namely mining, agriculture and agro-industry, tourism, hospitality and infrastructure. All of those have got enormous potential, more than they're currently contributing, and in our opinion that's where we must put our shoulder collectively to the wheel in the context of the partnership. The last couple of months has been spent aligning with our government counterparts on what should be the key interventions in each of those areas. And I'm confident that having launched it today with significant additional private sector commitment, you'll remember, Stephen, we've got 160 CEOs who've signed up to the pledge in terms of the partnership to date. Many more CEOs have stepped up and said they're prepared to lead these individual streams, that we'll see real progress in the coming months. And we've committed to back to the country at large every 3 months at a maximum on the progress that we're making relative to the targets that we're setting.
I mean, obviously the issue of local government is crucial to all of this. It's part of every conversation now. You can't grow the economy if Joburg looks like it does at the moment. Do you believe that anything's going to change in local government there? It's also one of the big focuses of Operation Vulindlela.
Yeah, it is a big focus of Operation Vulindlela. That of course is a partnership within government as opposed to a partnership between government and business. Although we do make technical skills available where it's possible and appropriate. In this particular case, we have identified the city of Johannesburg, we said so today, as an area where we think we need to lean in, given its profile, given the challenges that it's currently confronted with. 70% of GDP, 85% of businesses headquartered or located in the city, and operating obviously not only suboptimally, but dragging down the progress as a country that we're making. We've said that under the right circumstances, with an appropriate counterparty that has the authority, the capability, the competence, and the credibility, we will engage with them appropriately, and we're talking to the government at the level of the presidency about how best to do that at the right time.
Martin Kingston, thank you. Chair of the Steering Committee of B4SA.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets.
8 minutes to 7 the time. Well, I suppose more developments in the saga around the National Transmission Company South Africa and the amount of money it's paying independent power producers for curtailing the power they produce. To oversimplify it, power producers have a contract to supply electricity to the grid. When the grid has too much power, they have to stop producing that electricity. When that happens, the NTCSA pays the producer for the electricity they could have produced if they'd not been able to curtail it. Now it looks like they're finally speeding up their payments, and some of those companies had been getting very concerned, and some of the banks that funded them seem to be perhaps a little worried about that as well. Jose Malesha is an energy expert, looks at the financing of these things too. Jose, good evening. So it seems the volume of electricity generation capacity that is being curtailed has been a lot higher in the last couple of months. Why has there been more electricity on the grid now than there was in the past, especially when historically winter was a time of higher demand?
Good evening to you as well as the listeners, Stephen. The reason is that we have now a higher energy availability factor, resulting from the much more increased performance of Eskom coal-fired power plants, which we previously had issues with. That's one, and also the generation that comes from some of the renewable energy projects that are being put online. That is the contribution.
Okay, so then was it foreseeable that this would happen and that some of these power producers would have to curtail their production or their generation?
It should have been, because infrastructure. So what happened is that most of the resources that we have, renewable energy resources, are located in the Northern Cape for solar and mostly in the coastal areas for wind. And so most of the projects are looking to maximize the generations. They are going to those locations. But historically, our biggest infrastructure is located within Mpumalanga, where the coal-fired power plants are. So there needs to be a development of infrastructure to meet the needs of these new projects. So because of that unavailability of new infrastructure, there was an agreement to say that there must be curtailment in order to allow more projects to come online. But it comes at a cost to the consumer and to the system.
Okay. Now, I don't quite understand what happens with the money flow here. So when the NTCSA, when the grid operator has to pay out power producers, and I understand why, if you've built the power station, you've built it expecting a certain amount of demand, you've signed a contract to provide it, and now you're told not to provide it, you're out of pocket and the financing falls apart, which is why the National Transmission Company has to pay you out. That I get. Does it mean that the National Transmission Company then loses that money? Is it now out of pocket? Is it a case of saying the higher the level of curtailment, the more money it loses, or is it balanced out in somewhere else in the system?
Well, what has happened is that NERSA approved this framework, and in that framework, they included the multi-year price determination and provided approvals per financial year up to 2028 in terms of the limit within which that can happen. But I now see numbers like 2 billion rand, and I know that those numbers were like millions of rands per financial year. So I'm not sure. I haven't looked at that number to understand what is going on. But typically in other countries like Chile, Brazil, which are being made as an example, the curtailment relates to inability of the system to connect the generators, not a systematic constraint, which is the case in South Africa, where you are now having generators continuing to be connected to the grid, knowing very well that the grid infrastructure is not sufficient. So therefore the curtailment will take place, and it is a waste in a way.
Okay, I mean, are we getting to a point where something is not going to be sustainable, where it's just not going to work? I mean, I'm quite excited to see we have too much electricity, Jose. I mean, I remember, the wet coal of 2007. But if this harms the financial model, isn't it going to create problems for us later on? Because in a way, while electricity is all about managing electrons, it's all about managing money, really, as well.
It's all about managing money, and it's all about the impact on the economy or consumers in the system. So consumers will firstly be paying for compensating for the curtailment. They will be paying for replacement. And then they will also be paying for investments in future transmission infrastructure. So this is not sustainable. But it probably relates more to the Renewable Energy IPP procurement program, which was a specific procurement system under government. Now that you are seeing the entities outside, like contracting with each other and looking at a potential opening up of the market, I would not expect this to continue. In any case, the framework is up to 2028.
So it can change then?
It can change then, and we don't know what it will change to, because this one ends in 2028.
Okay, and I presume, under the current system, if the NTCSA were not to pay out these curtailments, the consequences of that would be far worse than anything else. So it's going to have to keep paying them, and the money will come, I don't know, from somewhere in Eskom, I suppose.
From you and I.
Yes.
So yes, the power purchase agreement that was signed with 20-year agreements, and the first projects were in 2013. So those projects indicate that it's a take or pay agreement. So if the facility is available to generate that electricity, and there's no ability to transmit it, then NTCSA has to pay. So it's a legal obligation. It's not just it's a legal obligation. So what could have been done is to say there's no transmission infrastructure, therefore new projects cannot be accommodated, and then they would continue to pay only the ones that are in the system. But they decided that they want more. And so that is the waste that is happening now.
I mean, the only other way to do it is to either find a proper funding model for the transmission system, or in the areas where this electricity is being produced, to put up a smelter there. But that's still 20 years.
Yes, that's still 20 years, and it's a bit complicated because you need reliable supply for things like smelters.
Yes. Fair point. Thank you very much indeed. Jose Maleshe, I really appreciate that. Energy expert on the financing of it as well. And just a reminder of how technical and complex, how many elements there are involved in some of the decisions that we have to make around electricity. All in all, though, I mean, if you look at the sheer amount of renewable energy that's a generation capacity around the country now, it is just incredible how quickly things have changed. On that point, you with the Money Show at 7 o'clock.
And now, the Money Show
With Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets. Plenty to come in the next little while. AI and education. I mean, can you imagine the money that can come in there? I'm in two minds about AI and education. I know everyone will say, get with it, blah. I mean, let me tell you the story that I came across on Reuters this evening. I mean, it scares the hell out of me. So there is an AI researcher. His name is Sinan Kandemir. He's originally from Turkey. He's in Texas at the moment. He's a computer science student at the University of Dallas. And this is how Reuters reported it. And he came across, there's a code sharing site. It's called GitHub. Strange name, I know. GitHub. And he came across what looked like an attempt to sabotage a piece of sort of open source software. So he put a warning on their kind of blog post and said, look, someone's trying to sabotage this. There was a whole herd of then other people who came in on the same sort of blog post or the same kind of chat room and said, no, this is not happening. You're just wrong. And lots of technical explanations as to why you were wrong. It then turns out that all of those kind of digital identities have been created by a British AI bot, right? I mean, just think about this. You think that these are real people, they're attacking you, And people are watching this. I mean, this is the equivalent to you saying something on X or LinkedIn or something, and suddenly a whole lot of people disagreeing with you, and you discover it was one AI bot that created all of these things, would have populated them with histories and the whole bit all in seconds, and then attacked you. It's the same thing. And this is because, in the end, someone was able to work out what had actually happened and was able to stop it. But it is unbelievable how scary that is. And yes, Anthropic's Mythos 5 model was behind it. This is one of the ones everyone's so sort of scared of when it comes to cybersecurity. So when you talk about AI and children, I don't know, I get a little nervous, I have to tell you. But that sort of model, doing that, getting out of the sandbox, they call it, I find very scary. You'll speak to Siphumelele Zondi in just a moment. Small business focus, Bulelani Balabala will be looking at customers, why customers buy once and don't come back. And then in investment school, Dr. William Wright, he's already here. He's the lead data scientist at Differential Capital. We'll speak to Sifiso Skinjana as well, the managing director of ESG Analytics. Can you be ethical and systematic at the same time while investing? One of the great things is the arguments around what is ethical and what is not. I mean, is it ethical to invest in the future of humanity? Yes. Is it ethical to invest in Elon Musk? Discuss. 9 minutes after 7.
The Money Show. Tech Thursdays.
So I was describing that story to you a moment ago about this software programmer who saw an attempt to sabotage code, went online, said this, and then was attacked by a whole lot of people who turned out to actually be parts of an AI bot, which had just created it. And despite that, the tech sector really pushing for AI to be used more in the classroom. Google saying that they will have a 1-year Gemini subscription for students who use their AI tool. Some schools, actually here in South Africa, will start piloting a humanoid robot as a teacher assistant. So interesting. Siphumelele Zondi is our tech expert. Siphumelele, good evening. So, I mean, Google Classroom is a big thing in my house. I presume this is going to be slightly different.
Hello, Stephen. So, yes, well, what they're doing here is integrating some of those Google Classroom features and other features that they have in terms of education into their Gemini AI tool, which is a subscription tool, but they want to make this freely available for students in various parts of the world, including South Africa, for at least a year. So I suppose it's their way of getting students to log onto this thing and create accounts and be on it, and as they're piloting it for a year.
So who's introducing this as sort of humanoid robot? I mean, who's in charge of that coming to South African schools?
Interestingly, that's a robot called Iris. So Iris has sort of been moving around different schools in South Africa, and it seems to be a partnership between a South African KZN-based initiative with an initiative that's based in the Middle East. And what they've done now is that Iris is going to be produced at the Dubai Trade Port in Durban, and so basically that's going to be a locally built robot, and they say that it speaks 11 languages. This robot called Iris, that's going to now be a teacher assistant in various schools in this pilot project that is going to be happening, that the government is going to be having in various government schools.
Okay, so I mean, how's the pilot going to work? Is it going to be? I mean, I presume it's not going to have power over children.
Well, so they've identified 5 schools, and it also seems to be 5 rural and township schools, and some of them are no-fee schools as well. So they want to see how it's going to work in those scenarios. So the way it's going to work is that it gets loaded with material, and then the children can sort of like use it as a teacher or a guide in the classroom if the teacher's not available, play around with it, ask it questions. I suppose because they're going to see it as a toy almost in a way. And when you say it's not going to have power over children, toys sometimes do have power over children. Technology sometimes does have power over children. So it's actually going to be interesting how they then relate to this particular teacher who is a robot in school 24/7.
So, I mean, I can go in lots of directions. By the way, I think this is the plot line of Toy Story 5 is, around the power of digital toys. But I can see a group of children thoroughly enjoying a sort of humanoid robot, right? But once the novelty wears off, don't you just have something that a normal phone set to speaker mode can do? You can talk to it and it will respond.
Well, that's the thing, because yes, it might be moving around the classroom, going up and down, and you press it, and yes, it will work the same way that a phone, the same way that a tablet is going to work. But the hope here is that if you have it in the classroom, children might be more engaged. They might want to play a lot more than they would if you have a human teacher, and maybe that's why they're considering that maybe they can pilot this project in schools, especially rural schools.
I presume there'll be regulation for all of this?
That's the problem, right? Because it seems like the adoption of technology is going ahead of, and yes, it always has. It goes ahead of regulation and policy. And that's the problem here, is that there is really no education regulation when it comes to technology. And if you look at it, for example, in the higher education sector, each university has been doing its own thing as it wants. There is really no policy that's guiding teachers and schools. And now this tool is being introduced. Yes, it is a pilot project at the moment, but there's no regulation that really guides onto what is to happen and what's next. Is there a regulation that's going to be developed before it moves out of the pilot phase into more schools, and whatever the findings of that pilot phase is?
For years, we've been talking about trying to close the digital gap that happens, between kind of well-resourced children from well-resourced families and well-resourced schools and children who grow up with really very few resources and poorly resourced schools. And every time there's a new technological thing, everyone thinks, well, this will be it. For years, we couldn't print textbooks and get them to the right place. And we thought, well, maybe, tablets would be the thing, because you could buy one and you would be able to put every textbook on that. And I don't know if it's made much difference. So I can understand the enthusiasm for AI in doing that, but I'm afraid to say I'm still a little cautious about it.
And it never has, right? Because at a certain point in time, a couple of years ago, the government was piloting coding in schools. That never really took off, and we're being told that it was going to be rolled out in just about every single school that's in the government system in South Africa. So that didn't solve the problem, because what we ended up finding there is that even the schools that were, I remember meeting one school that was piloting this at an event, and they said they did not have enough resources even for the pilot project. And you found that when they've tried to introduce, for example, your tablets into tablets and computers into some of the township schools in Gauteng, for example, the problem there was that they would sometimes get stolen. Some of them are found in a shop in downtown Johannesburg after they've been stolen from schools. And so none of these interventions, because we still have real, very South African problems that technology is not quite solving. And it could be, even with the humanoid robots, the security could be an issue as well. Will there be enough? Yes, they say they will be producing them and building them at the Dubai Trade Port down in Durban. But with that, what are the cost factors in order to get them to all the schools? Is there even a need? That's also another thing, because you do have teachers in schools. We do hear about the shortage of teachers in some schools, and now humanoid robots are there to assist teachers in certain schools. Maybe they can close the gap in schools that have a shortage of teachers, but maybe not. And so it's very many questions, and it leaves us with question marks on every single project that's tried to close the digital divide in schools in South Africa, even in urban and the semi-urban areas that are near the cities. It hasn't. And so it's going to be interesting how this one works.
Yeah, all right. Siphumelele, thank you. Siphumelele Zondi, the tech expert. I don't know how you feel about AI in schools, I have to say. I find, as I say, on the one side, I'm a little bit cautious. And I mean, in places like China, they've actually, the government has been able to say, you have to remove some of the sort of emotional features from chatbots, because people were, they thought, forming lasting emotional bonds with I don't know what it is, a large language model, large language model and I don't know if that really works. Where do you go? We walk down the street. So yeah, I think, obviously these things are going to come into classrooms in some way. The trick is you've got to manage it so carefully. And as we've seen, with the internet now and with AI models getting out anything can happen to a young person that'd be quite scary in a way. 18 minutes after 7.
The Money Show. Small business focus.
Small Business Focus is brought to you by Capitec. Start up or scale up with Capitec, the business bank for everyone. Well, tonight's topic, we're looking at why a customer will come into a small business once and then not actually come back, especially when you spend so much time and energy getting that customer to come in the first place. Bulelani Balabala is a township entrepreneur, runs several organizations around this. Bulelani, how's it? Thanks so much for coming in. So you get a first-time customer. You want to turn them into a repeat customer. Why can that be so hard to do for a smaller business?
I think it's difficult for a number of reasons, and I think at the back of it, let's think of it this way. The first month you go out there, you find 100 customers. You do nothing about retention. Then the next month you look for another 100. That is not scale and growth. It's insanity, because at some point your energy is going to run out. So when you then think about the reason why it then becomes a challenge is that first and foremost, the guys are, I think, the biggest challenge that you come across is that majority of the small businesses really just trace the transaction instead of building a relationship with the customer. The moment that EFT clears or that cash is received or that order is delivered, you worry little, you don't even follow up, you don't even check in on that customer, you don't even check in on whether or not they were actually happy with the product. And I think in most cases, I think about my early years as an entrepreneur, you don't want to check in because you're scared. What if they say they don't like it? Now you have to do something about it. But that is what actually genuinely shows the customer that you are in it for the long haul with them.
I presume that after that first sale, you're kind of excited, but you can make some mistakes too.
No, definitely. You definitely can make tons of mistakes. I think a number of mistakes that are made by small businesses is they disappear.
Yeah.
Don't disappear on your customer. Check in on them. And I think this then also creates the amazing opportunity for you to actually even upsell to the customer. And most small businesses think that their actual biggest problem is finding customers, where it's not actually your biggest problem. What you need to be fixated in is retaining the customers that you have. Think about it this way. If one customer has bought your product, then that customer has validated that there's something of interest to other customers about your business. But when you've got a customer coming back for the second or the third time, that customer is actually validating to say that a plethora of us who are customers who look like a certain archetype are interested in your product and services. And what you then need to harness, you need to harness that captured market and continue to then broaden to those particular customers.
It's also just when you're able to keep a couple of customers for a long time. When someone tells me they've been a long time customer of something, I'm much more likely to use that something because I get a sense that they know it's reliable.
Yeah, no, definitely. And I think for me, you think about a couple of key things, right? Obviously customers are looking for a number of different things, which is why I think I've said it on the show a number of times, guys, ask customers for feedback so that you start to churn out what they're actually looking for. But I think some of the three key things that always comes to mind for me is really consistency, reliability, and you being able to consistently deliver for them. I think the long and short of it really is what customers are really interested in is someone who's going to keep their word, whatever it is that you advertise. And I think the interesting thing is that we put all these philosophical things on our flyers, our websites, our banners. Then when we're held accountable, you want to put up a fight. No, just deliver on your word and don't put anything out there in the market that you are not interested in delivering on. Because the one key thing that you want is you want the long-term customers. You want customers that are going to come in and that are going to say, we're buying into your vision. You are reliable. You are consistent. You check in. There is a definite relationship. And I think one example on this is this. I had a client for a number of years. We had built a very strong relationship where I'd go in and sit and meet this client once or twice a month, and we just have coffee, talk nothing about work. I think years in, this particular lady sits me down and she says, listen, I'm sitting with a quote from my manager of another supplier who is 2 times or 3 times way cheaper than you. Here's the thing. We don't want to stop working with you, but however, we can't ignore this particular costing and pricing. Don't drop your price, but is there anything that you could potentially add to your value offering? Because you make our lives easier and everyone gets along with you and you guys actually deliver. So we don't want to shift. In that particular case, you then think that the logical thinking of a lot of small businesses, I need to be the cheapest, but the cheapest is a race to the ground. No, guys, build long-term customers, because they help you to then even define to a funder, when you are looking for funding and capital, machinery and equipment, that you actually have a retained market. So you're able to access more customers and being able to prove that you've got a retained percentage of those customers.
Sure, it's quite a relationship, eh? For someone to come and say, look, this person's sort of cheaper than you. Customer experience, and when someone comes back, when competitors are selling similar products like that, how important is that customer experience? I mean, this is the personal relationship. You've got to keep working at it. And sometimes I find, you can start a WhatsApp conversation with how did this go? But if you can then move it into something else that you're just talking about as humans, why Kaiser Chiefs are terrible, then you can continue forever.
Here's the thing, right? I think at its very infancy, I think with a lot of small businesses, I mean, the product is not unique.
Yeah.
Right? Because I think majority of small businesses don't have big budgets for R&D and so on and so forth. And I think in the first couple of years when you're starting out, you really start out with whatever is the easiest, whatever you can afford, whatever you can latch on to whilst you've got this big idea. So by virtue, there's no uniqueness there. What is going to set you apart, guys, is I think that maybe before I say that is you don't build a business by replication or duplication. You build it uniquely by you, the founder, expressing your character and putting it out there to the customers. So then that is what actually drives uniqueness. Remember this key thing. People buy from people that they like. People buy from people that they like. Find the people that like what your business is about, what they like your vibe and your energy as a founder, and go out and hunt out those people, because those are the people that are going to help you to churn out your business and take it to the next level. What is going to get the customer coming back, it is not going to be the fact that you've got the nicest label. There is something that's going to consistently get your customer back. Ask that actual customer, because they've passed maybe 5 other shops. They could have bought it online. They could have bought it from a friend or other shops, but they chose to come to you. It is not by sheer measure or the virtue of the fact that you're the best in the world. There's something about you. Ask your customer, what is that thing about you? Then you then start to then harness the unique selling proposition.
If you realize you're a small firm and people are coming to you and they're buying once, but they're not buying again, where do you start with trying to fix that? I mean, what do you first look at? And part of it, I'm afraid, might be your personal manner, or how much time you have, or whether your cell phone reception is terrible. Where do you, cell phone reception drives me mad. How do you start?
I really love where you started there with, because, seldomly we often look at all the external factors. We never look within, because I think sometimes we go into businesses and start these businesses because you like the product. And I think this then becomes the unique opportunity where you actually sit back and you ask the customers, in actual fact, do customers actually even like the product? Do they even like the service? And what other open door factors or touch points within our business, whether it's websites, phones, and all these other things that are actually dormant doors where people actually keep knocking and no one's actually answering? I think those couple of key things are important. And I think, what I want to also put out there to the listeners and the small businesses that are actually listening to this, and actionable items for them to sort of then consider. We constantly tell you on the show, build that client book. We're not just saying it for the sole sake of saying it. Build that client book. It doesn't need to be a long client book with a number of headshots. No, man. Name, surname, contact number. Ask that person, if one person has bought cake, there's a likelihood that they will buy cake for someone else time and again. Get into a conversation with that individual so that you then understand. Build a client book, consistently check in on the individual. And guys, when you check in, don't spam the individuals. Yeah. Don't consistently, on the only thing that you do is send them promos. Find unique manners of capturing their attention while still consistently conveying genuineness and authenticity in wanting to actually connect with that individual.
Bulalani, thanks so much. Really appreciate it. Bulalani Balabala is a business speaker and a township entrepreneur. He's been involved in the sector for quite some time. So Bulalani, thanks so much for coming in this evening. Really do appreciate it.
The Money Show.
Investment School.
25 minutes now to 8 the time. One of the sort of philosophical, moral questions about investing is around ethics. And you don't, necessarily want to put your money to the purpose with which you disagree, to sort of be philosophical about it. You don't want to invest in something you personally don't like. At the same time, you want to make money. So you've got to be quite careful about that. And I made the point earlier, is it ethical to invest in the future of humanity? Yes. Investing with Elon Musk? Well, there's a more complicated question. Tonight we're talking about, can investing be truly ethical and systematic at the same time. Dr. William Wright, the lead data scientist at Differential Capital, is with us. William, good evening. Firstly, the whole issue around ethics, where numbers are easy, right? I can see what the rate of return is of any company on the JSE if I want. Ethics is a lot more slippery, and I suppose that's where it starts to get quite complicated.
Yeah, absolutely. Thanks for having me on the show, Stephen. And that's where frameworks like ESG come into play, which stands for environmental, social, and governance. And basically that's an attempt to try and assess a firm's investability in metrics outside of stuff like traditional financial numbers, like returns or, conventional risks. Because, investors now are more and more wanting to have some sort of value alignment between where their money goes and the returns that they want to see. And that demand isn't going away anytime soon. The question is whether you can systematize this or have some sort of rigorous regimental process whereby you can assess, how ethical is this investment, or, is compared to a different investment, say, in the same sector or a different sector.
I mean, and I suppose you can look at a set of facts of two people with roughly the same frameworks, actually, and they can come to different views about whether this group of companies amounts to an ethical investment or not, or how ethical it is out of 10, or even worse, out of 1,000. You could have a really complicated conversation about those things based on the same set of facts.
Absolutely, and that's partially because it's very difficult to try and, make an ethical judgment and convert it into just a pure number. To say, is the way this company's structured or governing aligned with my ethics? How do you assign a number to that? And then how do you effectively weigh all of these ideas together in a consistent way? And there's lots of different ideas around this and frameworks for it. And that's why it requires quite a lot of discussion, because there's many different ways of approaching this, and that results in differing scores when it comes to calculating what, the ESG for a given company is.
So when you talk of a quant fund, which is the ultimate kind of by the numbers, right? You sort of put in an algorithm, you tell it to do certain things based just almost entirely on numbers, and it does those things. Can you really build ESG and ethics into a formula like that that's based on numbers? Because now you're trying to assign a value judgment a number.
So there's a two-player system here. There's the rating agencies and firms that actually generate these ESG numbers, and then there's how the funds interpret them and use them after the fact. Normally, the numbers get generated in a process that starts with company disclosures. So, the various regulatory agencies around the world will require companies to disclose certain things. They'll combine that with, media packets and reports based around the companies, as well as questionnaires that they send out to the firms to, fill out and, assess. And where there's gaps, they'll build in estimates to try and, fill the holes. And what the fund will do with those numbers is try and apply different techniques to it based off of what those numbers tell them about the company. So there's a few simple ones we can talk about. The most sort of basic one is this idea of negative screening, where effectively, if a company falls into one of a certain group of so-called, sin stocks, then it's just flat out excluded. And, that's
gambling,
simple.
Cigarettes, alcohol.
Exactly. It's, simple, straightforward, but it's also quite blunt, and it can be quite, damaging when it comes to, potential returns, and also doesn't necessarily tell the full picture.
You're with Investment School. It's 20 minutes now to 8 o'clock. Dr. William Wright is the lead data scientist at Differential Capital, and we're talking about being ethical and systematic at the same time. And we're joined now by Sifiso Skinjana, the managing director at ESG Analytics. Sifiso, good evening and welcome back to the Money Show. When you are trying to build ESG into a portfolio, I would imagine that over the last sort of 5-10 years, there's been a lot more demand for this from investors. I imagine that the situation's really changed.
Yeah, good evening, Stephen, and of course to the listeners at home. It's actually been quite topsy-turvy insofar as investor expectations are concerned. I think there was an initial wave of investor expectations to move into some level of ESG compliance and some level of ESG alignment from a portfolio perspective. And I think then there were a number of developments that are happening both in Europe and the US around the targets and the frameworks that were being used. One of the big issues was the science-based targets, where some of the instances there, for example, that it might not necessarily be aligned to the enterprise ask. And so I'll just take an example of a REIT, which is a property investment portfolio, and we might think about green, buildings, solar roofing, etc. But investors are asking different questions about what's the cost of capital. And so you've got on the one side the kind of the wave around moving towards a more decarbonized, a greener building, whereas the investors are saying, am I going to get my money's worth on the other side? And I think that's probably what's created a little bit of an on and off exercise, I think, in Europe and US around particularly some of the ESG-based portfolios, as well as investor expectations around that, and then making sure that the company's choices are aligned with investor interests.
William, so there are companies that are supposed to include this in their ratings, right? And Moody's and S&P, which, as we all admit, had a great global financial crisis. Do they agree with each other most of the time on these things?
So when it comes to ESG, no, not really. There's actually been some interesting research that came out of MIT, where they studied 6 of the largest ESG rating agencies, including MSCI, Sustainalytics, S&P Global, and that when they were able to sort of compare how they all rated the same set of companies, they actually found agreement less than 50% of the time. Sure. And the spread, when it comes to comparing, between agencies on a given company, would spread from 30% all the way up to 70%. And, you mentioned credit agencies, just for context. Normally Moody's and S&P agree about 99% of the time. So that just indicates how wide the spread really is.
So, Zafisa, when you've got such a wide spread where ratings agencies disagree so much, I mean, it's a wide open field in some ways. And I imagine some people must just shake their head at all of this. It makes it so much more complex.
I think, for me, Stephen, we needed to rebase the questions. I think a lot of investors on the African continent have already I think, are looking for alternative benchmarks beyond the S&Ps, and primarily because some of the way or the methodologies that they use in rating investability on the continent is not necessarily fit for purpose. And so when we think about it, and then I think it's if you look at how I think the DFIs have probably led the way in the logic definition around ESG, primarily around then meaningfully saying that how do we think about one, sustainable returns, but two, creating a top and a bottom layer on, for example, risk-weighted assets. How does it translate into how a prudential authority thinks about an ESG portfolio? In the current shape and form, it is very vanilla. It looks exactly like how most of issuances would have looked. And so and hence the banks don't even differentiate much in terms of pricing. If you're looking at a gender bond, a green bond, etc., you're looking at very, very, very minimal differential between all the banks. And in fact, if you look at all the portfolio transactions that have in place, you'll find that it's syndicated. So Nedbank, Standard Bank, and Absa will be on the same transaction, which means the pricing is largely aligned. And so they haven't used ESG as a competitive or a pricing mechanism there. I think initially banks went to market and saying we're here. The next question that is emerging now is how do we meaningfully, I think, use it as a competitive edge? And I think that's certainly where you're starting to see more innovative pricing structures and almost the return of blended finance in its original impetus coming from the DFIs, now starting to how do we blend concessionary finance, grant funding, and some form of commercial pricing into a facility or a vehicle that ultimately doesn't prejudice those who particularly are not the ones actually who are increasing global heating and all those things, but ultimately for them to also journey with us as we think about more contemporary facilities in supporting their journeys. I think so when we look at those DFIs, I think they're the ones who are probably giving us a lot more interesting innovations in how they're thinking about ESG beyond the rating agencies.
William, some people have done this very well over the years. One of them is actually a company I didn't know very well at all called Robeco, and they've been running things like this since 1995.
Yeah, absolutely. I mean, they really have a 30-year track record dealing with things that have only really become, popular and topical quite recently. But not only have they been, participating in the sustainability space, and so much to the extent that they developed the original index that was originally spun off and sold to S&P Global to use in their ESG, calculation frameworks. They have their own, quantitative fund, which, combines sustainability metrics, a quantitative model, as well as traditional, financial indicators like, value and such. And they've been able to, come out as a AA rated fund in terms of performance, as well as also meeting sustainability goals. So it's proof you can do it.
I think, Sifiso, to get down to the nub of this, if you're an investor and you're thinking, I want to invest ESG, you want to know, is it going to cost me? And I've been fascinated watching some stocks that would not normally be considered sort of ESG. So think of some of the tobacco or oil stocks that have been, really boosted by what's been happening in the Middle East, for example. Now, you might have lost out a little bit over the last sort of 6 months if you weren't invested there. And some people are going to say there is absolutely a trade-off and some are not. How do you see that? I mean, your company is called what? ESG Analytics.
I think, Stephen, we, for at least for my sons while I was still on the trading desk, we understood that it's quite important to also think about especially when you're dealing with complex markets that are potentially high returns or high loss markets, and you think about a core set-like portfolio. And so you've got your core portfolio that in essence, call it resembles what we would call a balanced portfolio. And then your ESG becomes your big bet as a satellite investment. And so what you're looking there specifically then is potentially some of the areas that could be interesting. And so I'll give you some examples. So data centers have emerged as large goblets of water in energy, but they've also emerged now as an asset class in the property space. And so you might be thinking, okay, cool. This is a new asset class, data center. Some of them are able to demonstrate how they're able to use reticulation as a cooling mechanism for some of their GPUs, and therefore they are responding more sustainably to the big AI boom. And so you're looking not specifically at an AI stock, but looking at a data center as a property portfolio because of the way they've responded to the pressure point that are associated with their operating model, which is large water usage and as well as large energy intensity. The same thing applies to, for example, the beer stocks, and it's a thin stock for some people. And beer is largely water intensive, but the amount of investment that is going into, for example, grey water systems innovation, etc., is actually going to give you as an investor, probably a view that there's actually some delta that's probably going to come on the back end because of how much investment is going into the innovation spend, because they've got a legislative push type of pressure point. And same as mining. Mining has had license to operate pressure points from social labor plans, etc., in the way in which they've thought about sustainable communities, resilience in communities, etc. And so when they have now gone into devices and tech for detecting seismic shifts in underground, being able to create safety alerts, etc., those are some of the things that then might actually be interesting from an investor's point of view, that actually this is going to be the new wave of how we support mining-related health and safety-related issues. And so I think there's value on the fringes, and hence I'm calling it the kind of the core and satellite portfolio approach, as we are figuring out how to embed sustainability-based investing logic into our mainstream.
We're speaking to Sifiso Skenjana, the economist and managing director at ESG Analytics, and Dr. William Wright, the lead data scientist at Differential Capital. Can investing be truly ethical and systematic at the same time? A few more minutes to go. It's 8 minutes now to 8.
The Money Show with Stephen Grootes is brought to you by ABSA Group and DHL Go Trade. African SMEs are now closer to global markets.
The Money Show. Investment School.
6 minutes to 8 the time. We're talking about being ethical and systematic in investing, both at the same time. Dr. William Wright, lead data scientist at Differential Capital. Sifiso Skenjana, managing director of ESG Analytics, are with us. William, there's a wonderful example of the kind of paradox of this around Tesla. So at one point, it was sort of removed from an ESG index, and then it was reinstated, and it didn't actually change anything.
Yeah. So this was in 2022. The S&P removed Tesla from their ESG index. And I mean, it was removed for very real reasons, relating to, things like, labor issues, the way that they handled federal investigations into their autopilot system and whatnot. But when you think of Tesla and you think about their core business, I mean, you don't really get much of a greener business at the moment than producing electric cars, right? So, they get removed. But then at the same time, you have a company like ExxonMobil, big oil, still, retained in the actual, index itself. And it's important to remember here that these things typically are gauged per sector. So you can have, on aggregate, a company like Tesla that is, far better in terms of environmental impact than an oil company getting removed. But ExxonMobil, in the context of its sister companies in the same sector, could be comparatively a better investment from its environmental impact, the social impact, and the governance side of things. And as you correctly say, the next year, Tesla is brought back into the index with minimal changes, if any, to the actual underlying features that caused them to be removed in the first place.
I mean, when things like that happen, Sifiso, it sounds like some of this could be a little bit of a nonsense. I think people feel that they want to use ESG investing to make sure that their money is used for things they agree with. And here you've got an oil producer being judged as better than an electric car producer.
I mean, I don't think that's inherently very different to what we initially, I think, as we were introducing the conversation earlier around sin goods, where people have got a moral position on cigarettes, etc., and therefore it's not a position that they inherently want to hold in those kind of stocks. I think for me, what becomes more interesting is when we think about just we take it to the basics, in terms of how do we measure value of an enterprise. And so you can look at a discounted cash flow analysis, always average cost of capital, ultimately when you're looking at, either cost of equity or expected return on the company. And some of the things that do come in there, I think from an ESG lens, Stephen, is things that now are probably going to increase the cost of capital. And so with what's happening, for example, I mean, if you just look at, for example, CBAM B4, which is the carbon border adjustment mechanism that is now live 1st January this year, which is EU, in essence, emissions trading systems-based taxation for all goods from South Africa that go into Europe, or actually from the world. And so you've got carbon taxation in South Africa, as well as then Europe-based taxation as you're going, and aluminium is one of the big players there. And so what you're looking at here is that the cost of capital is actually going to increase by virtue of the legislative framework moving underneath our feet, primarily because that just the cost of doing business is inherently going to get more expensive by virtue of your carbon footprint. And so that for me is, Graham, it just takes us to the basics, whether you're using a DCF, whatever level, formula to assess the value of an enterprise, you're going to start to see that it's going to have an impact on the quality of its gearing. It's going to have the impact on the return of the assets, etc. And I think those are, for me, more meaningful questions to ask about enterprises, and saying, at a sustainability overview and not using ESG specifically as an investment metric, what are the revenues at risk for this enterprise, and how do we price it in the way in which we create value? And that same apply for the tech stocks, because if data centers are going to catch a hiding because of their resource intensity from a water and electricity point of view, there's a point in time where your price earnings ratios are actually going to go down.
Sure.
And so how do you then think about building that into your portfolio mechanism, making sure that then ultimately you've got
Sure.
the right level of risk adjusted return? And so it's a new SOP ratio.
All right.
I think that has an ESG adjustment at this point in time.
Sifiso Skinjana, thank you so much. Economist and Managing Director at ESG Analytics. Dr. William Wrights, Lead Data Scientist at Differential Capital.
The Money Show with Stephen Grootes is brought to you by Absa Group and DHL Go Trade. African SMEs are now closer to global markets.
Still negative in the US, I'm afraid. The Dow Jones down 1%, the Nasdaq down 0.96, the S&P 500 down 0.59. Bond yields still very high there. We will, of course, talk about all of it tomorrow. Good evening, it's 8 o'clock.